Good evening, everybody. Nice evening here in Pittsburgh, Pennsylvania. And tonight we've got the great pleasure of having Johnny Seville with us, talking to us from New Zealand. So he's over there for a wedding. So it's always good to have Johnny on with us. He has a much refined, when I say trading techniques that he can teach people how to learn how to invest with a whole different perspective than other people like myself. So it's always good to see what other people's techniques are, because what might work for one person may not work for the next person. So with that, Johnny, welcome to the Candlestick Forum. We're anxious to see your information tonight.
Well, thank you so much, Stephen. It's an absolute pleasure to be here, and as it is always to kind of talk about the markets with such a great group of people. So greetings to everybody. This is one of my this is obviously a hot topic at the moment, and as we've seen, the markets have been extremely turbulent. And many people have talked about the term chaotic, and so the focus of tonight is to discuss the what has driven these chaotic markets, and to try and put some reason behind it. Okay, and then if we can add that, obviously put into the context of what could happen next, based on the indicators that we've used to predict these movements. So how many people, by the way, are hearing me speak for the first time, or how many people have heard me talk about these types of things before? Johnny talks funny. Yes, I do. I have I have an Australian accent. Okay, a few first timers. All right. Many times. Hey, Gary. Okay. Well, let me give you a bit of an introduction. Of course, as with anything, we have the standard disclaimer, but as we will be talking about live stocks with a Q&A session towards the end. But guys, let's talk about a quick introduction to Acorn and myself. I have been trading for 13 years. It was basically after my job in a video store. It's the only job I've had. It's my passion. It's been my life so far. And I have a fundamental background growing up in the mining industry, but technical has been where I focus mostly. And my focus, my approach to the market, and therefore Acorn's approach to the market, is to focus on candlesticks, to look at price action, to look at, most importantly, therefore, what pattern that creates, to see if you have an extremely high probability pattern, and if we do, to then look for the special ingredients of where is the smart money going. So that is my approach. Once I find a highly effective probability trade, I will then trade at the stock, or I will use options to leverage the move, usually by buying calls or puts. So that's a little bit about me. A little bit about the company. We started teaching in 2007, and this is something we've done since then. And again, the approach is to look for the smart money. Okay. Now, doing this, we found some key strategies which alerted us to the drop of the market in 2008. And the problem, so we saved our butts there, had a lot of students, and the problem is that, well, the benefit is we saw these same criteria come through recently. So we've been titling the current market conditions the big one. Okay, and what did we see happening? Well, from a fundamental standpoint, and then we'll get to the technicals, just to look at what the story was, we saw big problems with not just a slowdown in China, but an almost complete stop of the decade of Chinese growth. We saw obviously issues like Greece. Yes, it's a small company, but country, but they owe billions of dollars of debt. Okay, so that has a big impact when people stop paying those debts. Okay, so these are the stories behind the market. The problem is that stories don't necessarily result in good trading opportunities. It's a background. But you need triggers. So, I mean, how many people here in the room have been feeling like the market should go down, feeling like the US is in too much debt, feeling like there's global problems that we're ignoring? How many people have felt this way for several years? Right? Yes, I think a lot of people have. Now, but whether you agree with that or not, the problem is that our opinions don't necessarily make money, because what makes money is where is where the smart money is going, because they ultimately have been controlling the movement of the market. So despite the fact that the apple may be rotten, it hasn't fallen from the tree yet. So, so what are some of the catalysts that can bring this this apple to drop? Well, basically, as we start to see this contraction in worldwide growth, highly leveraged companies that rely on growth and speculation start to contract. You see suppliers to resource companies themselves start to crumble. You get big bankruptcies. Countries go bankrupt, such as Brazil, for example. And what we can see is then we see a credit tightening, which makes it then more difficult for other companies to borrow. Consumer credit then contracts, consumer confidence contracts. The fallout is the domino effect, much like we saw in 2008. So that's firstly one of the big catalysts. We haven't really seen that yet, but we have seen some extremely impressive moves in the market to the downside without that happening yet. So that's why what we're covering tonight is still extremely valuable. So what else do we have? Liquidation in the stock market. Well, basically, as people start to liquidate, if people start to sell off, ETFs crash. You get when the greed turns to fear, there's no bid. So that's been the big thing about the market these last few weeks. Floor traders have been talking about the lack of bids, and the volume has been very light. If you look at the appreciation of the Dow, what's been pushing the Dow up? It's been IBM, it's been Chevron, it's been energy. And so the most of the points coming from the Dow rise have come from companies that have been in real trouble. So basically, you create a real vacuum if things go bad, and this vacuum is exacerbated, is magnified by the fact that there is an estimated $600 trillion of bubble of speculation in the market. Now, Danielle Parks is a great author, very great economist that I respect very much. She wrote a book called Juggling Dynamite. And in her book, she talks about the fact that if you took all of the worldwide speculated value or debt of speculated value and added it all up, that number would be bigger than all of the real estate in the world put together. So the amount of speculated value in the markets equates to when that starts to pop, or when there's the risk of that popping, smart money doesn't accept speculated value anymore. And this is where we start to see the markets pull away. And then companies go into survival mode. So for anyone who was watching the CNN futures last night and things like that, they're talking about the big mergers of large corporate companies, some of which in China being backed by Alibaba and things like that. I can't remember the names, but there was big mergers going on. Companies are in survival mode. So you see mergers happening. You could look at that as good for business. It probably is good for business, but they're banding together to become stronger when there's big threats in the market. This is a survival tactic in a lot of ways versus a everything's going so well tactic. Okay, so I've talked about the story. Now the story has been the same for a while, though. How do we time the story? How do we then decide, right, the story is now a good trade? And that is where we need to start. That's how we all make money, isn't it? So for that, we turn to charts. We turn to timing mechanisms. So the first thing I'd like to talk about in terms of timing is focus on this price action. Now, for those of you who are new to us, or haven't been following us, you can go to our YouTube channel, acornwealthcorp.com/YouTube, and you'll see that basically all through July and the beginning of August, we said, be careful. Here's the reasons we feel the market's going to crash. The same ones I just described now is what we were saying in July. We said, look, we feel the market's going to plummet, and buy puts, buy long-dated option puts, January through March puts on key weak companies. So why did we say that? Why was the story now valid to us? Well, the first thing we look at is as I said earlier, price action. So we'll take all these moving averages and things off, and let's just get right down to basics, something I'm sure many of you are familiar with, which is candlesticks, of course. Working with Bigelow, Mr. Bigelow in the Candlestick Forum, candlesticks are very, very valuable. And what we read in the candlesticks here was we look at what is the pattern that these candlesticks are creating. Now, there are about 100 different patterns plus that exist in the market, and these are like a playbook for a football coach. The market makers go through their playbook and decide what pattern do we run now. And they cycle through these patterns to keep us on our toes. Each of these patterns is clearly defined. Each of these patterns has very specific ways we trade it once we know what it is. So in my opinion, and this is the way I trade, there are very many valid ways to trade. The way I trade is I say I need to know the pattern first to know how to trade the stock. So I look at the S&P and I say, well, I need to explain why the stock changes direction. Okay, why did the stock change direction? Because that tells me support, tells me resistance. I look at the S&P 500 and I can see if I go back this far, and I basically account for all of the key changes in the market's direction, I get a support line that looks basically like that. Okay, I then do the same with the tops. Why could the market not go higher? Don't tell me it's news, because don't tell me that it just so happened that coincidentally bad news occurred at the exact same point on the same gradient. I don't believe that's true. I believe that we've been seeing a technically very bearish pattern build since the beginning of February 15 in a sense. What pattern is this? This is it's a rising wedge. A rising wedge is highly probable to break down. So when I see these building, I think I'm ready to short. It did break down. Now, because it broke down, we therefore know when one pattern ends and another begins. So guys and girls, quick trivia. How many people have trouble with this? How many people have trouble when they draw their trend lines going, like, where does one begin? Does it begin there? Do I connect those? Because that would work. Or what about this? Or in fact, is it that? Do I go from over here? Do people struggle with this? This is because trend lines can often be considered subjective. I would argue that they're not as subjective as you would think. The reason being is that trend lines are drawn by machines, high-frequency traders. High-frequency trading computers are not guesswork. They are driven by rules. And if anything is driven by rules, it means it can be reverse engineered and that there is structure, not chaos, to how trend lines come about. So how do we structure those trend lines? What we do is we need to go left to right. By going left to right, that tells us when a new data set begins and we start looking for new support and resistance. So rather than connecting all this, the most short-term important lines begin when we actually when they saw that breakdown. Hang on a second. Okay. Okay, so we saw that breakdown. Market broke down from the bearish pattern, rallied up into resistance, and then failed yet again. Support was created here. You'll see why this is all relevant here in a second, by the way. I know we're going back in time, but look at why this is very important. Now this support line then fails here. Something new is created. We get a reversal candle. We go from making lower highs and lower lows to higher highs and higher lows. So we get our reversal. So now we know to look for a new pattern. So that data ended here, and we look for a new pattern. This data stops becoming as relevant there. We look for a new pattern, and therefore we draw in our trend line once more, looking at all the reversal points. We draw our trend line here, looking for the reversal points. And what do you see? What pattern is created from this line forward? Anyone know? What pattern do we get here? Thank you. A head and shoulders. This is a head and shoulder pattern. Left shoulder, head, right shoulder, anomaly here, then a break. We measure now because we know the pattern, now we know how to trade it. Now head and shoulders, to trade a head and shoulders, it's one of the top 10 most probable patterns in the market. And of course, as traders, we want to deal with only the best, just like you're working with Bigelow, just like you're here hopefully to listen to me. Pick the best, and in the market, the best pattern is high probability patterns, things like flags, head and shoulders. So in this case, we have a head and shoulders pattern, and we go through, we measure from the head to the neckline, and we replicate that then from the breakout point, and you can see that takes us down to here. So this was why we were very keen to short the market heavily again on July 31st. In fact, the video we published on YouTube was on Thursday, July 30th. Now, it is a daily time frame. Sorry, I got caught up in my my drawing here. Yes, it's a daily time frame. Okay, so now we break down to this point. So the next thing, we're now looking for a new pattern that begins here. And you can see that we then get a sharp drop followed by consolidation, which of course is very reminiscent of a bear flag. Excuse me. So we can again look at the levels of this bear flag and draw those on. Not cooperating today. Yeah. And the other thing that we can also do is spot the resistance of where this flag comes down. Now, if you look over here, remember how I said there was an anomaly at this point? An anomaly doesn't exist a lot of the time. A lot of the time it means you're not looking for the right data. So when you connect this low with this low, notice that that perfectly connects with the high here. So basically we've now got a system, a roadmap of support and resistance areas that we're able to draw in from going left to right on the S&P. Okay, so what does this mean? What this means is that, in my opinion, we have obviously a short-term bullish market that's strong. It has been strong since the first of this month. I'll explain that in a minute. That's a very cool strategy of how to predict market direction. But basically, we can see we've broken this resistance. We have momentum in play. We have a powerful move up with expanding range candles, consolidation, expanding range candles. And we've broken this resistance level. We've also, if you go to technical analysis, we broke the upper Bollinger Band is increasing upwards. And excuse me, I'm drawing from the wrong place. If we go from our peak here to our decline here, you can see we also broke through the 50% Fibonacci. So short-term bullish based on our patterns and trend lines. Does that make sense to everybody? Can everyone see kind of how we've arrived at the idea of why the market would drop in the first place? That there was the head and shoulders, followed by the bear flag, and then why we measure from certain places, and then what we feel is happening now. Okay, excellent. So that is one type of support and resistance which is very important. Now, support and resistance is often considered to be based on price. And that's true. And the three most important things that we look at, and my core belief is that markets, stocks, futures will never change direction, or very, very seldom, unless they hit one of the three types of resistances: horizontal, directional, or moving averages. So I never believe that there is random movement. That's my mentality anyway. So I always must discover what the system of control is. Once I know the system of control, then I know what pattern it is. And when I know what pattern it is, I know how to trade it. I'll keep coming back to that statement today because you shouldn't be guessing. You should be resolute that you know what pattern it is, you know what rules apply to it, and you follow them. Right or wrong, you don't worry about whether you're right or wrong. You follow the rules. Now, but there is a fourth type of support and resistance which is not as well known. In fact, when Googling it to look up some of the statistics of this year so far, because I was putting together a lesson on it, I couldn't find any real information on this strategy whatsoever. So I'm very happy to talk to you now about something which is time-based resistance. As a resistance and support which is created based on very specific days of the month which have dramatic impact on where the S&P 500 goes. Does anyone know what that strategy is called, or does anyone know what days they are? I can see some of the Acorn students are in the room, so don't spoil it for anybody. Okay. The strategy is called open range. And what open range is it's basically a language of how the market makers speak to one another. I was taught this by a market maker, and he told me, taught it to me about 2 years ago. He said, John, you may not want to teach this to people because otherwise it may stop working. We've never taught it before. We put one lesson together for our Acorn members, but it's something we're sharing at the moment for a few different groups of webinars, and this is a special one, so we're going to share it tonight. Open range is where the first day of the month and options expiration, third Friday, are very, very important. Open range strategy dictates that on the first day of the month and the options expiration day of the month, we need to pay attention to what the range is. So I'm going to go to a different spreadsheet without all these lines on, and we'll define this. This is key to how we predict the big one, the crash, and what's going to be happening over the next few weeks, most likely. So open range, take these lines off. Open range is the first day of the month and options expiration day. So how we use it is we go in, and let's go into August. Let's say, just 1 second here. There was, okay. All right, so where are we going? August, Friday. Okay, so open range options expiration day was here. Okay, so the high and low of options expiration August is here and here, these two lines. Now, how we use the strategy is we're trying to predict where the market's going to go, where the smart money is going to push the market until the next open range day. So basically what I'm saying is this level is valid, these two levels are valid until the next open range day, then it disappears. A new range is set. Okay, so it's like a checkpoint. All right, so what we're looking for is whether the market, S&P, closes below or above that range. And if it does close below or above that range, it is likely to remain bullish or bearish until the next time. So what do we see here? Okay, there's a high of 2025 and a low here of 1970. We close below that range, or we break below that range. Look what happens. Market remains bearish all the way through until the new open range day of September 1st. So September 1st is created, and it actually happens to be at the bottom of the previous open range. There you go. High, low. What happens? Do we close above or below the range? No. We go sideways, meaning constant consolidation until then, until on Tuesday, September 15th, for the first time, it closed outside the range, which was there. Now, Tuesday, September 15th, if we look at a calendar, was 2 days left until a new open range is set, being the third Friday. So therefore, knowing this information, and knowing the way that the market was shaping up, based on this support, this resistance, this channel, we were able to then say with confidence that the S&P 500 should stay bullish, but only for 2 days. And then a new open range is going to be set, being options expiration Friday. And then we looked at where resistance was, based on replicating the trend line down here. And so therefore we anticipated that the S&P would rally to 2020 by Friday and then sharply sell off. And look what happened. We were able to anticipate that and using open range combined with support and resistance, and it rallied up, hit that level, and then shot down. Now that was the day that the Japanese exchange was up massively, and the news reporters on TV were saying what a wonderful world it was and how everyone's going to have a great day in the stock market, and it did the absolute opposite. Much like last week when everyone said the jobs report was terrible and everyone's going to lose all their money, and we rallied straight up. The news has been not very useful, but this has been. So where are we at now? Right now, we can see that a new open range was set on October 1st. This is the open range now. Okay? So therefore, we look at whether it breaks up or below. We broke up. What does that mean? That means that until October 16th, the market should remain bullish. And we have. And this is what then alerted us to then go and look for high probability longs, looking for bump and run formations, looking for the highest probabilities for long patterns. These are the stocks that we've been picking over the last 2 weeks. Arden, Elizabeth Arden, Avalon, AVP. I'll come back to some of these. These are all stocks that we sent out alerts to, which are also, you can see those alerts if you don't believe me. You go to acornwealthcorp.com/YouTube. We're basically averaging, well, I won't talk numbers. We're doing some really, really good numbers at the moment. And you can go check that out by looking at some of those videos. But AVP has been a great performer. CAI has been a great performer. We'll talk about some specific stocks here in a moment. I'll share with you some of the stocks that I'm currently in and what I think of them. What else? Helix, HLX, has been a rock star. This is still probably a great long. Look at Helix Energy, HLX. This is one we alerted back at just over $5. Now up at 640. A lot of these stocks that we're picking at the moment are doing 10 to 15% within about a 3-day time frame. We don't always get that, but right now we're finding a lot of opportunities of this specific pattern that are able to do that type of move. Now, having said that, we are also still taking puts, long-dated put options in the market because we still feel that even though we're trading stocks in the short term bullishly, that the longer term is still a dangerous picture. So let's flash back now to the topic of tonight, which is the big one. So what does all this mean? Well, what this means is this gives us a time window that the market could remain bullish to the 16th. Now let's take that knowledge and now go back to our chart that has all of the support and resistance lines drawn on. Okay, and we'll take off all these moving averages for a moment. Let's clean the chart up. So what does that tell us? It tells us that we're going to run into a resistance area of the 77.7% Fibonacci, the upward trend line here, the downward trend line here, and we can start looking at other moving averages that come into place. We're going to get a cluster of moving averages as well as trend line and Fibonacci resistance. So this could be a peak point where the market reverses. So when would we expect that to happen? We'd be looking towards the end of the week, next week. That then also gives us enough time to continue enjoying bullish trades. But yes, could very likely be a bull trap. So this is the first thing that we want to look for. The next thing that we want to have a look at in terms of things that we detect for smart money is we can look at money flow. Now, Twig's money flow, which is similar to Chaikin money flow, but just an edited version of that, or a different version of that, money flow indicates a very, very much so smart money. It's one of the most reliable indicators I use. I'm not interested in 8, 9, 10 different indicators on my screen. All I use to trade are moving averages, support and resistance, candlesticks, and where is the smart money going. That's all I believe you need. Now, other strategies use them. That's fine, but this is how I trade. So with this setup, what money flow does is it looks at whether the stock is closing high or low in the range. Okay, of course, that's what stochastics do. That's why I don't use stochastics. I don't need a stochastic to tell me whether the stock is closing high or low in the range. I can see it on the screen. So where the stock is closing is one thing that goes into where the smart money is going. It also looks at whether the stock is making a new highs or new lows. It also looks at whether volume is accompanying the move. Now, these three things are considered to be the sign of real trend. An uptrend isn't just higher highs and higher lows. It may technically be, but a tradable uptrend is really what we're looking to find, right? I mean, if a stock goes, let's look at something that we picked as a short recently. Take this example, INCY. Now, this was a short we picked here, where you see that September 16th. No, September 15th. We said, look, this is going to be an ideal short. Why did we say that? Well, let's just look at price action first. You can see that the stock was rallying up. And what happened to the candlesticks on Friday, Monday, Tuesday, Wednesday? What happened to these candles? They contracted. So when we get a contracting range, bearish pattern, within a possible head and shoulders that didn't end up playing out, but within a bearish pattern within a bearish pattern, and look at the volume. Volume went from 2.08 million to 1.26 million to 1.23 million to 1.38 million. Volume decreased, and then it just crashed. Back up to 1.4, back up to 1.87. So what I'm trying to get at is that smart money is indicated by several core functions of the stock, not just highs and lows, but highs and lows, volume, and the closing range as well. So rather than populate your chart with indicators like this and end up in overload, what we want to do is simplify it by saying, well, what's all that garbage, not garbage, but what's all that noise telling us? What is it ultimately trying to tell us? Is the smart money behind the move, or is it a fake out? Pretty simple. Do we go long or do we short resistance? That's the answer I think all of us are looking for, isn't it? So we go into money flow, and it tells us a lot about that. It tells us, is the stock faking out? And in this case, what do you see the smart money doing? Think of this line as the smart money. What do we see the smart money doing when we compare how much smart money was interested in the stock back in July at $119 compared to how much smart money was interested in the stock in September at 130? What do you see, ladies and gentlemen? What was the smart money doing as this stock went up? Thank you. They were selling to you. The best time to sell is when everyone else thinks it's a good time to buy. And that's why the news obviously doesn't help us. I mean, if I'm Warren Buffett and I own $1 billion worth of XYZ company, or $10 billion worth, do you think I'm going to go out and promote the fear of the market? Of course not. That's why the 1% keep on making so much more than the 99% who don't, because the best thing you can do as a trader is to keep the public ignorant. As a financial institution, is to keep the public ignorant. The less people know, the more money there is to make off them. To be purely blunt, the stock market is not chaotic. I believe it's a very well organized, dirty business with lots of patterns and well organized formations and purposeful short squeezes, all designed to get you to sell at the worst time and buy at an equally worst time. Not you guys, hopefully, guys and girls. But how do we avoid that? By looking at where the smart money is going in terms of numbers instead of stories. Okay? And what we see here is a smart money exiting. So money flow is a core factor that allowed us to combine the market that we looked at before told us to short, doing the analysis we just did. The pattern on this stock therefore said this was a high quality pattern to short. Okay? Still is. Okay? We saw the short-term pattern with the candlesticks, also bearish. And then we did one final checkpoint, which was to look at one other form of smart money, which is actually looking at what the directors and owners of the companies themselves were doing. And so now we bring this full circle from market technicals, market fundamentals, to stock technicals, stock smart money levels, and now we go into the actual directors themselves. Okay, now to do that, I've got my interactive brokers thing here. Let's change that. Right, sorry, Insider Cow. So here we can go to insidercow.com, and we can look at what the insiders are doing. INCY. Let's have a little look-see, shall we? So here we see a really beautiful setup. Now remember what I said earlier about the fact that the market wouldn't tolerate high P/E ratios because the risk on trade was not on. Money was seeking safety. That's why bonds were shooting up. That's why corporate high yield bonds that we'll talk about in a second were shooting down. So what's a prime target? Well, a prime target for a short is going to be a stock that has a P/E ratio as high as it gets. And in this case, 1411. That means if you make $1 million a year of money, you're selling your company that makes $1 million for 14,000 million. Now, who's willing to pay that in a market like this? No one. And that is why the stock has plummeted, or one of the reasons why. And this may be also why the directors and insiders of the company, from chief drug development officers to their general counsel to the directors to even the CEO himself, I believe, somewhere down here, or chief commercial officer, all getting out. And fairly large chunks starting at the beginning of the year going forward. So now we have full circle a perfect storm. Okay? We have a perfect storm, and therefore we waited for it to break at 130, and we suggested a short down to 113, where this support came into place. And of course, then you got another opportunity to short it again as it rallied up. Now, this stock is not going up, is it, ladies and gentlemen? Market's going up. Is this? No. Is Apple? No. We'll talk about these things in a moment. But this is the key thing, is that what we're wanting to do is we're creating a process that we go through where we look at the market, we develop an idea of what's going on in the stock market, based not on what we think, not on what our opinion is, but what the rules tell us. Okay, so what do the rules that anyone can learn tell us about the stock market? Okay, this. All right, so that means we're looking for shorts. Great. Well, let's now scan for shorts. Let's find high probability patterns that are setting up. Let's look to see if those high probability patterns have real weakness from insider selling, high P to E ratios. Let's look to see that they're right at resistance with the candles contracting. Let's look for all of those perfect ingredients that make the perfect storm. And if it's all there, then let's short it, right? And this is an example where all of that was just perfect. What else? AVGO is another one that I hold puts in myself right now. We picked these up when it was at 125. Market's going up. What's this stock doing? Nothing. This stock is the semiconductors that are behind all of Apple's gear. So when you look at what companies are leading the market at the moment, it's Chevron, it's IBM, it's companies that arguably are in real trouble. Like, I mean, in terms of they got problems. It's not the high quality companies like Apple, you know, things like that. A lot of these, the stocks that are rallying up are things like Cummins, that are just have been beaten down and are just getting these dead cat bounces. But you start to look at things like Apple and AVGO and a lot of these high P/E companies, they're all starting to drop. So we're finding high quality shorts because of this this big one picture we built. We're looking at these longer term high quality shorts where there is a big potential for a drop. Any questions so far? We've got we're going to switch over to a full-on Q&A period here in a moment, where we'll talk about individual stocks and so forth. But does everyone understand the picture that I'm building so far? Awesome. Okay, so the trick is I want everyone to stop feeling scared. So many people react to the market instead of anticipating the market. Let me give you an example of that. We had anticipated that on the S&P 500 we had broken open range, and therefore that by the end of that week we were going to rally up into resistance at 2018. What therefore do we do about that? It means that we're not scared. The next morning when I was in the gym when the market opened, and I was looking up at the TV and they're saying, oh, and the girl on this Canadian financial TV show was laughing and everyone was in good spirits, clinking champagne glasses, market's going higher, and I'm heavily short. You know, I still own about probably 14, 15 companies, puts, March and January puts in all of those. that are 10, 20% out of the money. I'm looking for, anywhere from 300 to 1,000% returns on those. But I've got, if the market goes up, I'm holding pain. But I didn't feel a single bit of pain. I didn't jump on my computer. I didn't leave the gym calling in a panic my broker, looking to reverse my positions and go long. I didn't panic because I'd anticipated that was what was going to happen. And when it stopped exactly on that resistance and fell down, it gave me comfort. We don't want to have emotions in the market. We want to have rules. And so we never worry about whether we're right or wrong, just simply if it meets the rules. And you can see the picture here tells us that the rules are telling us the market's at support. All right. So going into one last thing that I want to show you before we get into the Q&A is HYG. One thing I think you should really keep an eye on is these corporate high yield bonds. Another reason why we were able to make so much money in the drop of the market recently is because the S&P 500 has been going higher and higher and higher. But what do you see the corporate high yield bonds doing? This represents when smart money buys bonds in corporations, high yield bonds. Now, if smart money loved risk, this would be shooting up. Right now, it is, which is why, coinciding within the open range, we want to be bullish about the market. But again, this is also going to reach resistance levels soon. So we'll see what happens to the smart money. But this is another really, really good factor to look at when you're looking at the long-term picture and timing, is look at whether corporate high-yield bonds are moving with the market or against the market. And the interesting thing I wanted to point out to you is that why we feel this is still possibly a very, very good opportunity to look at some longer-term puts when we rally up into the new resistance zone. You can see that the smart money has been exiting this market since 2013. So all this rally has not been supported, at least by the money represented by corporate high-yield bond traders. 2009 rally, sure, but the 2009 rally was over to smart money when quantitative easing began in 2012, 2013. All right, so that is my checkpoints. I basically tried to condense, a 1 hour snapshot of my approach to the market, and hopefully everyone's found that helps. I've only got 10 minutes left, so I may not have time to go back over open range again. I can see a few people asking. I'll do my best, but what I'm going to show you now is I'm going to show you, if you do want to learn more, we made it really, really inexpensive to test this out. So let me show you what's involved in the webinar. I know you knew this was all coming at the end, but look, it's well worth it. I mean, we've basically taken all of these things and put them into a very condensed workshop. I should say condensed, a very concise workshop on how to take the ideas I've told you today and build it out into a fully fledged strategy. And then the next point of the strategy is how to scan for these. So now we know what we're looking for. How do you find it? How do we find what the best opportunity is for tomorrow? Or maybe there isn't one. What exactly do we do to put this into a package we can trade? And that's sometimes what people feel when they watch these workshops with me, is they say, wow, John, like you've done all this stuff, and look, you call these trend lines perfectly, but then I go away and I think, well, that was a good workshop. What the hell do I do now? How do I replicate that? How do I trade that? Well, this is how you do that. So what we've done is we put together a course where we teach you exactly how to scan for these opportunities every day using free online tools. Okay? And then we take you through the processes of how to draw the trend lines, how to use open range, how to put entry and exit signals, and basically how to take it from start to finish to, at the end of it, make money, simply, and do it efficiently. A lot of people spend a lot of time thinking that basically the more time you spend at something, the more money you make. In some things, that's true. I know I've been trading for 13 years. I don't think I truly came into my element of being as good as we are now until the last 3 years. I don't mind admitting that. And I'm still learning every single day. So time does have value, but make sure it's efficient time. A lot of traders will think that because they're spending time staring at the screen, that they're doing a job. But let me ask you something. If you know what you're looking for, shouldn't you be able to develop something to find it for you? Or shouldn't you be able to develop alerts in your day trading program to send off alerts when you should be looking at the screen instead of staring at it? Now, I get it. I'm not a full-time day trader, so I know there's people that love doing that. And there is a lot of value for looking at order flow and level 2 data and seeing how things change. But for what benefit? What if you can make marginally less for 80% less time? Now, whether you agree with that or not, this course will give you the tools to have that opportunity. If you still want to day trade, you love the thrill, go for it. But for swing traders, this is especially valuable because what we're going to do is we're going to give you the scans that will find day trades or swing trade setups the night before so that you can program them in. And then if you're in New Zealand like me, you can choose to day trade. Some days I do, and I'll day trade the first half hour, hour and a half. But most of the time I'm sleeping because all of my trades are programmed into my account the night before based on the scan. So, what's this course? How does it work? Basically, it's a very, very special production we put together. We launched it about a month ago. It was meant to be 1 2-hour workshop, and we had about 180 people who came in and purchased it, and we did the 1 2-hour workshop, and it was so successful we wanted to do another one. So we kept doing new workshops and adding on more and more content every week and running scans live with the audience and applying the strategies and created this course. So for you don't just get one workshop, you actually get all 4 workshops in the series. They add up to approximately, they're 4 2-hour theory sessions, but we also do lots of practical at the end. One of the sessions is actually 3 hours long. Another one is 4 hours long. But the theory is in the first 2 hours. You get all of them for the $97. The complete course. It's roughly 10 hours of training. We teach you the theory behind the scans. We teach you everything that's in the scans, how we develop the scan, what criteria we put into it, and why. So you understand and have confidence in the actual strategy. We go through the smart money, we go through the high probability patterns, the indicators we use to identify them, and all the smart money checklists that we use. We've had great success. It has been our most successful probably 2 months in the market, going shorting it, and probably the most amount of testimonials we've ever received. So we're very, very excited about it. The cool thing is if the market turns, we're also teaching you songs as well. Okay, so I'm just going to fast forward a bit because I want to make sure we have time for Q&A before we run out. I'm happy to stick around if people want to email me questions, but I know we've got a deadline time-wise. So let's go into. Let's have a quick look here. So yeah, so basically to enroll, you simply go to acornwealthcorp.com/night. And that's right, sorry. And then we don't want it just to be on demand because you do get these 4 2-hour workshops straight away. But then to wrap this all together, we'll also invite you to a live workshop. We have live workshops where we practice these scans live and pick opportunities for the next day. We do them every Tuesday, Thursday. You'll get invited to the next one, which is on Tuesday, October 13th, and you actually get to see it all in action for new positions. So acornwealthcorp.com/night. There's an error there. Don't put the S in. It's just HTTP www. So www.acornwealthcorp.com/night. Okay, let's have a look at the questions. I'll leave that link on the screen. But There we go. All right, so questions. Do I trade Forex? No. Not that I don't like Forex, but I'm a lifestyle trader. I trade to travel, basically. I have no interest in, my idea of wealth isn't how much money I have in my bank account. So if I die with 100 million, great. But my definition of wealth is your ability to create wealth with money. So I think the guy with 100 grand in his bank that can make 10,000 a month off of it is wealthier than the guy with $1 million in his bank who only makes 1% a year. That's my thoughts, just personal. But so the focus for what I do is to stay within that concept, trade within a way that creates lifestyle, and for me that means not having to be in front of the screen if I don't want to be, if I'm not in the right time zone. So everything I teach is more about setting up trades, setting up based on patterns and support and resistance, programming it in, and then really not looking at the stock trade at all after you've programmed it in. It either trades or it doesn't. Will not be available October 13th, no problem. If you're not available for that live lesson, we can switch it to any Tuesday, Thursday over the next month. Do you get the scanner to put on your computer? Yes, it is. Is it a one-time payment? Yes, it is. Is the market going to crash? Yes, we believe so. We believe that the market will probably rally up to the top-end trend line, and then what we'll see for the beginning of after the options expiration Friday is we're going to see a key turning point or test for the S&P 500. Now let me make a very important point. I'm not sure, Becky, if you're still here. I mean, how long we have to keep taking Q&A. But I'll go as long as I'm allowed. Let's have a look at, if you look at the key thing, as long as I want. Okay, great. All right, so basically the trick about trading is the difference between alpha and beta, okay? Lots of people, they focus so much on the S&P 500 and the market. They say, is the market going down? Is the market going up? Okay. But just remember that unless if you're only trading the indexes, that's not the most important question. And if you're only trading the indexes, you've got to be pretty good at it because that's how the big market makers work, right? I think there's a better way to trade for a lot of beginners and newbies. I'll leave this, bring up the number again there for you. Yeah, I believe there's a better way to trade, and because it's not a stock market, it's actually a market of individual stocks. So when I trade a stock, I want to get the backdrop of the market right because I want to understand where the most highest probability is going to lie. So if the market's bearish, I'm going to look for bearish patterns, and that'll increase the probability of their success. But if a stock truly is a strong bear stock, even if the market goes up 5%, that short could and should still drop. So I could be, if I treat the market as individual opportunities within the stock market, then a good trader, a great trader, should be able to make money shorting in a long market and going long in a short market. Now, where that becomes extremely powerful is where you can get a robust strategies for longs and shorts, and on any given day be positioned in both. So I am never only long or only short. Right now, I'm about 40% long and 60% short with my capital. So 60% of my capital is tied up in puts that expire in January to March next year. The other 40% I'm using to trade swing trades long. The beauty of this is what happens, for example, like I said, AVGO. Market's going down, up, but I'm making money shorting on this one. I think we're up. We bought the puts at $3.20 They're currently at $3.90 something over a week and a half. That's a 30, almost a 25% return. So I won't argue with that. I hold on to that one. Then again, you get stocks like OREX, a biopharmaceutical company. Looks nothing like the market. Looks nothing like the Head and Shoulders and stuff we've been talking about in the S&P. So if the S&P drops tomorrow, OREX is probably still going to go up. Look at stocks like DDD, 3D Systems. I know nothing about the company. I don't care to. But again, this stock has its own individual personality, where basically, if you of a momentum trade, where it's kind of gone and broken through the 50, the 20, and the 9-day moving average, making the stock extremely potentially an opportunity for it to just shoot up. It's just been so pressured that this stock is down from $95 to 13. There's an individual personality here that I like. So I've kind of gone on a little more than I intended to about this, but I don't trade Forex, which is where that question came from, and I like to look at an absence of global or macro influence on my trades, because the most important thing for me is actually the individual stocks pattern. Okay, anyway, so we'll come back to a few other questions here. Is the software included or an additional purchase? This software I'm using is about $5 a month, and it's called Incredible Charts. But you do get a month. There is a free version, which costs nothing. Okay. Do we expect the S&P to go down, to go to the 200-day moving average in the next couple of days? Let's have a look where the 200-day is. Okay, the 200-day. Do we expect it to go through it? Oh, to it. Okay. By the end of next week. That's a hypothesis. Right now we had a very strong system of resistance right here at 2,000. We've broken that, so we should assume and respect that as key support until it's broken. So right now we're at support. Resistance certainly seems to be up here at 2060. I would anticipate that by the end of next week we'll get there. Yeah. How does the open range work with an individual market that's not optionable? Well, open range is used to 60% of stocks move with the market, roughly. So if you can predict market direction, it's not the most important thing, but it certainly is. If you can predict it, adds probability to your trading patterns, knowing which patterns to look for. So everything you can get right adds more and more to your setup. This is why this workshop, hopefully you'll be attending, is called the perfect storm, because no one can be 100% right. We can only create hypotheses, and the more ingredients we add that are in our favor, the better and better and better things become. So take for example ACHC. So ACHC, Acadia Healthcare, one of the shorts, again, another one that you can see the market's shooting up. This one is not. This is one that continually makes profit for our students every single day. And now you'll actually see this in the workshop. One of the videos in the on-demand workshop you'll get right away, that you'll get tonight. You can go in and watch me pick this on August 6th is the workshop. Watch that video. And about halfway through, we're going through the smart money scan, and there's about 36 stocks that come up. And the second one on the list is this one, and we got all the students in there, and I say, guys, I don't need to look any further. This is the one, Acadia. Bam, that's our short. And the P/E ratio was off the chart. We have an upward moving channel, which is bearish. After 3 touches on a channel, that's normally when you'll start to see a good breakdown. So 1 touch, 2 touch, 3 touches. There's the break. Rule of 3 is what I call that. So rule of 3, and then so August 6th we're saying, look, let's see this touch support again, and let's short it when it breaks $80. And it went from 80 all the way down to 60. huge drop. The options were off the charts if you had a target set to get out. If you didn't, it rallied up. It created another rising wedge. Second opportunity we suggested to people to short it right there at 75 bucks. Bang, all the way down. We're approaching that same level that we talked about before, around 60 bucks. So just about at that target again. Again, look at, so all of those were there. Bearish patterns, bearish breakdowns. Look at the Twigs money flow. Divergent as hell. Let's go to the smart money flow. Let's go to Insider Cow. Let's see what the insiders were doing. ACHC. Bam. Haven't done anything all year really, and then all of a sudden the COO, the 10% owner, another 10% owner, chief executive officer, and the chief financial officer all of a sudden decide that they're going to sell a lot of stock. Bang. Out it goes. Now, I guess the obvious response you may have is when you look at something like this to say, well, yeah, well, this is a really beautiful trading setup. Things like this don't always happen. You're damn right they don't. And that's why you shouldn't be trading just any old stock. You want to be finding high quality trades, not quantity of trades. So yeah, if this only occurs 5 times in a month, then guess how many trades I take in that month? 5, plus maybe the 1 or 2 stupid trades that I always do because I think I'm smarter than my strategy. And guess how many of those work out? 0. Well, no, well, not that bad. But I mean, yeah, we all get cocky sometimes. But look, but when I'm trading with my rules, it's where I get the best performance. So yes, I'll have a bit of fun, a bit of a gamble here and there, better odds than Vegas. But where I make all my money really is just following the same boring setup when everything lines up in the perfect storm and it says, do it. The rules say yes. And if the rules say yes and my heart says no, you still do it because it's your emotions that you need to get out of the way. So hopefully that makes sense. I'm happy to talk about other puts that I'm in or longs that we're looking at, but I'd like to see, are there any other key questions here that I haven't followed? Why are you bearish long term? The debt, overseas debt, an impending credit crunch, I believe, is going to happen, and the fact that we have significant issues that have not yet been dealt with that we addressed at the beginning of the workshop tonight. Which platforms does the scanner work on? Our pre-packaged scans come with work on Metastock, TradeStation, Thinkorswim, Incredible Charts, and TC2000. And we also, that's just one of the scans. The other scans are also you can do in other online websites. We'll give you the variables to plug in. You plug them in, click scan, bang, there's your list. So if you don't have one of those programs, you can still, for 90% of the scans we teach you, you can still run them and then take the 5 or 6 stocks that come up and put them into your charting program to analyze. Is the live sessions only for 1 week? Yes, it is. But if you want, you do get an option to take the live sessions for an entire month for only $9 extra. You'll be given that option when you register. It'll say, do you want to get the Smart Money Scanner package? It's $9, and I highly recommend it. And take that with a pinch of salt because I do own the company. But in all reality, it's a very, very good service. And basically, that month is our executive summary service where we do a live lesson every Tuesday, Thursday, all the time. I just finished doing one before I came in here tonight. But one of the key value points people actually get from it is we send out a short little video because I mean most of you are going to be here in the Candlestick Forum and so forth with Stephen. So maybe you won't have time to watch our live sessions. We do send a video out every day alerting you to what we're going to trade the next day, where we're going to get in, where we're going to get out, and that gives you that too. So that's basically what that covers. Will the webinar be recorded? Yes, it will. Anything else? Any other questions, guys and girls? Oh, I'm missing I forgot to scroll down. Sorry. There's a few other questions. Are your strategies for buying puts, calls and puts? Yes. In the workshop, we'll discuss buying puts and calls. We'll also be discussing stocks. If I'm going to be a lazy trader and I'm not going to be looking at my screen for a week or 2 weeks, I'll only buy stock because I can just program entries and exits. I don't have to worry about decay or anything like that. So a lot of my trading is lazy. I'll admit it. I don't like to have to work too hard to make money in the market. I want to be able to let my strategy do the work. Could I make more by watching it every day, 8 hours a day? Probably, but not much more that it's worth the time. That's just my personal opinion. Okay, do we teach open range? Yes, open range is taught in this workshop. Do you get reports every night? Yes, you get reports, an email every day. You'll also get a video every day, and you'll get 2 classes a week on Tuesday, Thursday. Anyway, any suggestions on how to trade options during earnings season? That is a great question. Yes, it is actually the lesson 1 of that strategy is taught in the very first lesson of the perfect storm. So actually, when you go into the perfect storm, when you're going through these workshops, the first video teaches the options during earnings scan, how to find stocks to buy short-dated. Now, this is different from long-term. How to buy puts that expire within a day or two to look to make potential 300 to 1,000 point moves. Now, there's a lot of risk that comes with that, so it'll talk about those also. But yes, the actual, I forgot to mention that, the scan for options during earnings is actually in that very first video of this 4 2-hour workshop. There's tons in there. So, yeah. I'm in Australia. Is it recorded? I'm in New Zealand. Yes, it is recorded. Everything's recorded. Everything we do is recorded. What's your best short for tomorrow? Well, I haven't looked at any new shorts because I'm holding so long. What's the phone number? Oh, there it is on the screen. I'll put my chart up above the phone number. Contact us on. There we go. All right. So let's talk about a couple of the puts that I found recently. AV. Let's look at this one. Where is it? MLM I was looking at yesterday. This looks decent. MLM has is right at resistance of what looks like a descending neckline head and shoulders pattern. It's underneath the moving averages, and the risk reward is good. 165 to say 170. It's $5 risk, 3%, but the reward from say 165 down to 145 is 20. Right, so we've got a $20 potential return for $5 risk. That's a 4-to-1 risk-reward ratio. So again, don't ask yourself what is, well, avoid the question of what's the best or what's my favorite, but what is the most qualified short based on rules. So this is a 4-to-1 risk-reward ratio. So what I would do is compare this to other stocks and see, based on quantifiable things, which is the best short. The best, sorry to go on, but I get excited about this stuff. The best short is not the highest probability one. Okay? The best short is not the highest probability one. The best short is the combination of the highest risk-reward ratio with probability and putting those two together, probability and risk-reward. Okay, so that's the key thing. What's the Ultimate Trader's Toolbox? It's an 8-hour course for those of you who are newer to trading. It teaches all of the trend lines, candlestick analysis. I'm sure you've learned a lot of candlesticks from Stephen. That might be a bit of double up. But some of the more Acorn-specific strategies around those types of things. Do the scans work in Radar, Screen, and TradeStation? I don't use TradeStation, Frank, so I wouldn't like to answer your question incorrectly. I would imagine they do. Because we just had, but we only had it developed 2 weeks ago for TradeStation. It was the last one to come, so Look, if that's but look, if even if that one didn't, there's several other scans that do. So that's all I can say, unfortunately, without knowing TradeStation in and out. The next two workshops. Big Al, if you have purchased the Perfect Storm 2 weeks ago, then we will include you in for free next week. I don't know exactly which workshops you're talking about, but if you are a member of this workshop, you can attend any live lesson we do in the future of this session complimentary. Just maybe email me, Big Al, on coaching or info at Acorn Wealth Corp, and either myself or one of my team will get back to you. Let's have a quick look at other puts and other stocks, and then we can. I'll go look at the questions. Do you think Apple will go up short term? It's a threat to this market rally. The scan work on Fidelity, not really, not the technical one, but so we teach you about 6 different scans in this workshop, and all but one will work on anything, because you can do them with online substitutes that we give you. So if it can't be worked in your program, we'll give you a program that will work on and cost you nothing. So there's no reason why anyone shouldn't be able to use all of our scans. But if you are absolutely focused on only using, your platform, then there's one that is developed into these different packages. How many months do I go out for options? Right now I'm looking at March. And typically 10% out of the money. Okay, let's have a look at some of the other stocks here. TPUB was another long, very, very speculative, this one. But this one's one we alerted people to at just about on the open yesterday morning. This one looks like it wants to go higher. Tribune Publishing Company. Insider buying. Not a lot of real news about them. I don't really know what they do, but again, nice good hammer candle there. Broke the 9-day moving average, and then that's going us up 5.95%, 8.6% today, so 12%, 13% over 2 days. DDD I talked about. What other shorts? CWST was one I found yesterday that I'm watching. Oops. CWST is not a bad short. You can see it's, I already showed you that one. VCYT isn't a bad short. You can see if this one rallies up into resistance. PII, Polaris. Have a look at this one. Again, these are long-term puts I hold, but so you can see short-term support here, but very much still under the moving averages. And if you go to a week, so on a daily time frame, it may rally into the 20, maybe rally into the 50, but this isn't a short-term swing trade for me. This is a much longer-term hold. I expect this to drop to around $65, right? So all the puts I expect, all the puts I hold, I'm looking for a 40 to 50% drop in the stock price by January, February of next year. All the puts I hold, I'm looking to make a 500 to 1,000% return, and all the puts I hold are also positioned monetarily wise in small amounts so that I'm only risking what I afford to lose. So let's say you would normally buy 100 grand worth of stock, and I realize that's probably not the case, but let's say that was the case. You put 100 grand in, and you were saying, right, I'm only going to risk 2% of my capital on this trade. So of your portfolio of $100,000, you're only ever going to risk $2,000 maximum per stock you buy. So you go and buy 10 stocks, 10,000 in each. Your stop loss would allow you to therefore only risk a maximum of $2,000, which would be 20%, which is far too much probably on a stock trade. So your risk might only be more like 0.2% because you're only having a stop loss of 2, right? But your maximum allowed loss is 2,000 if you maxed everything out. That means even if you had 100 grand in a trading account, the most you'd ever put into an option trade like this might be, say, 4,000. So if the trade goes against you, you lose 50% of it, 60% maybe. So the way I approach it is for every $100,000 of capital, I'll generally look at a $2,000 to $3,000, say, ratio of what I would put into these types of big one plays. You don't need a lot to make a lot if things go right, but you do want to risk, the biggest thing you want to do is protect your capital. If you put your order in and you don't know if it went through, just shoot us a quick email, Joe. We have a team of people. I'm in New Zealand, but my staff are all still in the office working hard in Vancouver, so just shoot us an email and we'll handle that for you. Okay, let's have a look. The open range secret code, no problems. I find it hard to keep secrets like that. So hopefully it makes you some money. What is our win to loss ratio following your scan? I just had, look, I had that done. I can't bring up my my spreadsheet. Basically, we just hired a data analyst to go back over every single alert we've published since January this year. The results are I hate talking about results because everyone says, oh, we made this amount of money, we made that amount of money. It just sounds like, oil salesman. I don't want to come across as that. The key thing we're here to give you is knowledge. If you learn how to trade properly, you'll make money. If you learn how to trade my strategies and don't apply them properly, you'll make none. So, I mean, talking about big results leads to emotional decision making, which is generally a losing way to trade. Our results have been great, and I think the average profit we're looking for on a stock is about 8 to 12%. We typically aim for about a 60% win ratio when markets are going bad. We've seen as high as 80 when the market's going in our direction. It's kind of in that realm. But if you go to acornwealthcorp.com/YouTube, you can actually see our the picks we've been making all the way back to January. And if you want to look at the results, then see for yourself rather than me promoting them. Where in New Zealand am I? I'm in. Just came from Rotorua to Wellington. Okay, I think we've answered most of the questions. Obviously, if you found this valuable, we will be doing this again on Tuesday of next week, and I'll be sticking around I usually stick around for however long we need to answer everyone's questions about every stock in the Tuesday event. So that's why they can go for 3 hours. So you'll get a great opportunity to ask those questions there on Tuesday. Once again, the link is acornwealthcorp.com/night. The last couple of questions here. If you use TOS or Metastock, can you download scan packages for both? 100% you can. How do you discern how many trades to take so that you focus on the high risk-reward probability trades? Great question. What I do is, let's say that there's 20 good opportunities and I had 10 grand. I'd take my 10 grand and I'd split them across all 20 opportunities. But let's say that I didn't want to do that. Let's say I found 20 opportunities and I wanted to take my 10 grand and split it across 5. How would I do that? Well, what I would do is I would use OCO orders, or one cancels other. So I would say, okay, let me figure out where the absolute perfect trade could be. And that's what you need to do when you trade anyway, regardless of capital management. When you look at a chart, ask yourself, is this stock, where's the perfect place to buy this stock? Okay? Where is the perfect place to buy the stock? Now, this is something which happened to me. I missed a trade yesterday because I'm picky. So I looked at ATI, and I looked at the fact it was down at 2008 lows. So that basically it's already crashed. It's already down at the low here. And I said, well, where's the best place to enter this? We looked, oh, this is the one I missed. Sorry. This is a great trade. Where's the one I missed? The one I missed was, I think it was, I can't figure it out. It's somewhere. Anyway, the point I'm getting at poorly is that when you look at a chart, figure out exactly where the core support is and enter there. Most people chase stocks and buy above support because they're afraid of missing the trade. They've got FOMO disease, fear of missing out. Again, don't be afraid of missing out. Also, don't be afraid of being right or wrong. What you need to worry about is whether you've followed your rules. So just because a trade is exciting doesn't mean you should break your risk-reward strategies. So there's lots of trades I miss because they'll go up 20% and I'll say, damn it, had I have only set my buy alert 5% higher, I would have been in that. So the way I avoid this and try and diffuse the emotion is I'll take maybe 10 trades and I'll find what the perfect opportunity to get in would be by my strategy. And we'll say, okay, if we can get it right just above that 5-day exponential or 9-day exponential on a momentum trade, that would give us 8-to-1 risk-reward ratio. Okay, so it gives us 8-to-1 risk-reward ratio. Now, we may not get there. We may miss out on it. But what we'll do is we'll find 9 or 10 other trades just like it and program those all in. So what will happen is your brokerage account will go off and try and buy all of them at the best point. And so let's say you've got enough capital to buy 5 of the 10. As it fills up and some of those stocks hit their respective perfect entries, you'll end up with whatever 5 stocks hit those entries first. Or maybe only 3 of them do. But using OCO orders, you can if I'm answering your question correctly, I don't worry about forcing the trade. I just put all the orders out there, forget about them, and let them get filled or not filled. And then, of course, your bracket order is programmed in as well, so that even though you may have forgotten that you were even trying to trade that stock the next day or two, your stop losses and targets are already in place to protect you if you do fall off the face of the earth and forget, which has happened to me. It has happened. I lost internet for a week, and luckily all my trades were trading themselves because my bracket orders were in. Software package, good for purchase. Yes, if you get a new computer, it makes no difference. What about software upgrades? We don't sell software. We sell strategies, which you can use in anyone's software. So none of this will affect you if you do change software or if you change computers. Okay. I've tied everyone up here. Thank you for everyone sticking around an extra half an hour. I love teaching almost more than I do love trading. So I do hope you'll join us for a lot more of it through the Perfect Storm workshop. I'll leave the link up here and the details on the screen if you want to talk to us some more. But I'd like to once again throw a huge thank you to for everyone participating, and thank you, Mr. Bigelow, Stephen Bigelow, for hosting us. It is always a pleasure and a wonderful group of people to chat to. So have a wonderful evening, and I'll pass the mic back to you.
Thank you, Johnny, and very good stuff. Everybody, as you can see, this is all just information that if you use it, it's going to be adding to your mental arsenal of being in the right places at the right time. So for $97, you're going to get a heck of a lot more information than what you're paying for. So take advantage of this information. Johnny's an excellent teacher, and I think you'll get a heck of a lot out of it. So with that, everybody have a good evening. Johnny, thank you very much. Have fun in New Zealand. Yep. And we'll see everybody in the chat rooms.